Before you even think about spending a single precious pound of your anticipated pension rise, I need you to stop right where you are and pay very close attention to what I'm about to reveal. Because what I'm going to share with you in the next few minutes will absolutely shock every single pensioner living throughout the United Kingdom right now. The government has been publicly announcing and proudly declaring that they're increasing your pension payment, making it sound like wonderful news that will improve your financial situation. But what they're not telling you clearly is that hidden deep inside the complex 2025 budget are 6 completely new taxes and financial changes that could quietly and systematically take back significantly more money than they're actually giving you through the pension increase. The truly frightening part is that most people simply won't notice what's happening until it's already far too late to do anything about it. And by that point, thousands of pounds could have already disappeared from their retirement income without them even realizing where it went or why. But if you can stay with me for just the next few minutes and really listen carefully to what I'm explaining, I will show you exactly and precisely how these sneaky changes could end up costing you thousands upon thousands of pounds over the coming years, and more importantly, what you absolutely must do right now, today, to protect your hard-earned retirement income and safeguard your financial future during what should be your golden years. Welcome to UK Pension Pro, the channel that was created specifically for pensioners just like you who deserve honest, clear, and straightforward information about their retirement finances. This isn't just another generic financial channel filled with complicated jargon and confusing terminology that leaves you more bewildered than when you started watching. Every single update I share, every warning I provide, and every money-saving tip I upload is carefully designed and specifically crafted to protect your pension, secure your financial future, and keep more money in your pocket where it rightfully belongs. I dedicate myself to uploading videos on exactly these types of critical topics, the ones that directly affect your daily life and your long-term financial security, so that you never get caught off guard again by sudden government changes or hidden policy shifts that could devastate your retirement plans. So please, do yourself an enormous favor right now and hit that subscribe button completely free of charge, because this truly is your channel, providing your essential information, and I'm genuinely here to personally guide you through every single change that's coming next, whether it's good news or bad news, and I promise to always give it to you straight without any sugarcoating or political spin. Now listen very carefully to what I'm about to explain, because this is absolutely crucial information. The 2025 budget may have given pensioners what appears on the surface to be a small headline rise that sounds positive when you hear it announced on the evening news. But when you actually look closer at the fine print and examine all the details that the government doesn't prominently advertise, the picture becomes a lot more complicated and considerably more concerning. And unfortunately, many people could very easily end up significantly worse off financially than they currently think, or than the politicians want them to believe. So I'm going to take my time and explain absolutely everything in plain, straightforward UK English, using language that anyone can understand regardless of their financial background, and in a way that's genuinely easy to follow without needing an accounting degree or economics expertise. I want to be completely clear from the start that this isn't meant to be legal advice or professional financial advice that you should base major decisions on without consulting qualified experts, but rather this is just a clear, honest walkthrough of the current situation so you can properly see how all the different pieces fit together like a complex jigsaw puzzle, and more importantly, why some people stand to lose literally thousands of pounds rather than gain anything meaningful from these changes. The government has officially confirmed a rise in the state pension under the triple lock guarantee, which on paper sounds absolutely wonderful and like great news for everyone receiving their pension. The state pension will definitely increase by a certain percentage, and lots of politicians from all parties are enthusiastically pointing to that specific number as a major win for pensioners and proof that they care about older citizens. But here's what they're not emphasizing or talking about nearly as much. That cash boost you're hearing about is only one small part of a much bigger and far more complex picture that includes frozen tax thresholds that haven't moved in years, higher taxes being applied to savings and dividends that will reduce your income from those sources, new levies specifically targeting expensive property that could affect homeowners, and significant changes to how employer pension contributions are treated that will impact future retirees. When you put all those different things together and add them up carefully, you discover that small increases in your pension income or modest growth in your savings can suddenly push you into taxable income territory that wasn't taxable before these changes. And over time, that stealth tax, the kind that slowly creeps up on you without dramatic announcements, can completely eat up the entire benefit of the pension rise and then take even more beyond that, leaving you worse off overall. For those pensioners who are already struggling financially day to day, barely making ends meet while living on their UK state pension, these hidden changes represent a genuinely frightening prospect that could push them from just managing to genuine hardship. Many older adults throughout the country depend entirely on a carefully balanced combination of their state pension, which currently provides £221.20 per week for those receiving the full new state pension, along with additional crucial support such as pension credit that provides extra money to help with basic living costs for those over state pension age who have low income and limited savings. Others receive Personal Independence Payment, universally known as PIP, which provides vital help with extra living costs if you're dealing with long-term physical or mental health conditions or disabilities that affect your daily life, offering either standard or enhanced rates for both daily living components and mobility components depending on exactly how your particular condition affects your ability to function independently. Some pensioners still receive Employment and Support Allowance, commonly referred to as ESA, if they haven't quite reached state pension age yet, but have significant health conditions that severely limit their ability to work and earn income. Additionally, many older people rely on attendance allowance, which helps specifically with personal care costs for those over state pension age who have physical or mental health conditions requiring supervision or assistance, providing absolutely essential financial support for managing daily living activities that younger, healthier people take completely for granted. The winter fuel payment situation has become particularly contentious and problematic recently, as this benefit, which traditionally helped hundreds of thousands of older people with their heating costs during the expensive and dangerous cold winter months, has now been drastically restricted to only those receiving pension credit or certain other means-tested benefits, cruelly leaving many vulnerable pensioners without this crucial support precisely when energy prices have skyrocketed to unprecedented levels. Furthermore, the cost of living payments that have been periodically distributed to eligible households receiving certain qualifying benefits have provided absolutely essential help with rising expenses across the board, from food to energy to basic necessities. But the complex interaction between these various payment systems, your different pension income sources, and any modest savings you might have carefully accumulated over your lifetime can create an extremely complicated financial picture that HMRC's new automated systems might easily misinterpret, potentially triggering unexpected tax bills. First and foremost, you need to properly understand what the term fiscal drag actually means in plain, everyday terms that make sense. The government makes a deliberate decision to freeze the personal allowance threshold and the higher rate tax thresholds for several years running, sometimes 5 years or even longer. And that critical decision means that the amount you can earn before you start paying any income tax whatsoever does not move upward with inflation like it traditionally did in previous decades. So if your state pension, a private workplace pension, or savings interest goes up even a little bit because of inflation or the annual uprating process, that extra money, even though it might only be a few pounds per week, can suddenly push you over the tax limit for the first time in your life or move you closer to the next higher tax band, where you'll pay even more. The result is that you start paying income tax on money that you didn't pay tax on before, and for many pensioners on fixed incomes, this feels deeply unfair because you haven't actually become wealthier in real terms. You've simply received a small increase that barely keeps pace with rising costs. Yet suddenly, the government is taking a portion of it back through taxation. For many pensioners throughout the UK, this entire situation is completely new and utterly bewildering. You might have been comfortably used to your pension being effectively tax-free for many years because the total amount was safely under the personal allowance threshold. But now that allowance stays frozen at exactly the same level while your pension payment goes up year after year, and that's precisely where people miss the catch and fail to understand what's actually happening to their finances. Second, and equally concerning, the budget raises the tax rates applied to savings income and dividends by a couple of percentage points in the coming tax years. And that's definitely not a tiny, insignificant detail if you rely on bank interest, income from savings accounts you've built up over decades, or dividends from investments you made to supplement your pension. Before these changes, you might have paid little or absolutely no tax on that investment income if it was properly sheltered in tax-advantaged accounts, or if the amounts were relatively small and fell under various allowances. But with the new higher rates being implemented, even moderate interest from savings or dividend income from a modest investment portfolio can become noticeably and painfully more expensive from a tax perspective. Third, there are significant changes being made to employer pension contributions and salary sacrifice schemes that affect people while they are still working. And these changes can affect retirement pots indirectly, even if you're already retired, because they influence how much future retirees will have saved. Salary sacrifice used to be an extremely effective way for some higher earners to reduce their national insurance contributions and build their pension pot in a highly tax-efficient manner. But the rules governing these arrangements are being systematically tightened, and new limits are being put firmly in place. So the financial incentive for some people to contribute large sums in a tax-efficient way via their employer pension scheme will be significantly reduced going forward, and that will ultimately affect future pension pots and could leave some retirees with substantially smaller tax-efficient allowances or needing to develop completely different financial strategies in retirement than they had originally planned. Fourth, the budget introduces completely new property-based levies, specifically targeting high-value homes, and tightens various rules in ways that mean people who are asset-rich but cash-poor may find themselves severely squeezed financially. If you happen to own a very valuable house, perhaps because you bought it decades ago when prices were reasonable and it's now worth a fortune due to the property market, you could potentially face new council tax surcharges or special levies that are calculated based on property value rather than your actual income or ability to pay. And for retirees living on fixed incomes with no way to increase their earnings, that can create genuinely tough choices that cause enormous stress. You either somehow find the cash to pay the new charge from your limited pension income, make the difficult decision to downsize and leave your family home, or consider remortgaging your property in old age, which comes with its own serious risks and complications. Next, it's absolutely crucial to remember that many pensioners throughout the UK do not rely purely on the state pension alone for their income. They may also have a private pension they arrange themselves, workplace pension from their career, savings accounts they've accumulated, ISAs they've carefully funded, buy-to-let income from property they invested in, or small business income if they're still doing a bit of part-time work or consulting. And the budget's combined changes touch nearly every single one of those different income areas in some way, creating a cumulative effect. That fundamental reality means that the overall financial hit is often the result of several smaller changes stacking up and combining together rather than one single big new charge that's easy to identify and understand. For example, imagine a fairly typical situation where you're taking a modest private pension drawdown combined with some savings interest from your lifetime savings and perhaps small dividend income from some shares you own. This combination could easily push you into the basic tax band when you were previously safely under the personal allowance and paying no tax whatsoever. And with frozen thresholds that don't rise with inflation, you may find yourself paying basic rate tax right now and then sliding into higher rate tax territory just a few years later, putting you on a path to pay several hundred or even a few £1,000s more in tax over a single year compared to what you paid before. To help you see this situation more clearly and understand how it might affect you personally, think carefully about 3 simple but realistic scenarios that cover most pensioners. Scenario 1 involves someone who only gets the basic state pension and has very little savings in the bank beyond perhaps a small emergency fund. For that person, assuming they remain under all the tax thresholds, the triple lock rise is genuinely likely to be a real net gain in their pocket, and they will be among the least negatively affected by these budget changes, possibly even coming out slightly ahead. Scenario 2 involves someone with the state pension plus a modest private pension from their working years and some savings they've accumulated, perhaps £30,000 to £50,000 in various accounts. That person will face a considerably higher chance of paying income tax on their combined income for the first time, and the higher tax rates on savings interest and dividends will definitely bite into their monthly cash flow, potentially wiping out most or all of their pension increase. Scenario 3 involves someone with substantial private pension income, large savings balances, perhaps exceeding £100,000, possibly some investment portfolios, and a valuable home that's appreciated significantly over the decades. That person is absolutely most exposed to these changes and could very easily see thousands of pounds taken annually by the combination of frozen thresholds, higher tax rates on savings and dividends, and any new property levies, potentially making them significantly worse off despite the headline pension increase. It's also extremely important to stress and understand that these negative effects are gradual but persistent and cumulative over time. Once tax thresholds are frozen for several years running, which is exactly what's happening now, the number of people who cross over into taxable territory grows substantially every single year as wages, pensions, and interest rates rise even a little bit due to inflation. So the impact compounds year after year, getting progressively worse. What looks like a relatively small and perhaps manageable tax change in year one can translate into a cumulative loss of several thousand pounds over just a few years, and over a decade it could amount to